The first solvency framework is almost 40 years old now, and obviously a lot has changed since then. So what is the new framework expected to achieve?
Well, the new framework's primary objectives are to enhance first the protection of policyholders across Europe and to create a level playing field across member states. But while the new regulation is quite comprehensive and it runs to thousands of pages of rules and advice, two key features stand out. First, there is a calculation of the solvency requirement. They now will be based on an economic basis instead of an accounting one, and they will explicitly take into account risks which did not appear in the previous system, such as market and operational risks. This is important because many insurers' failures in the past were precisely the consequence of a poor management of these risks. Second, the regulation also emphasizes the development of strong risk management processes and tools, and combined together, these features will change the way insurers make decisions and steer their business.
It's still many months before Solvency II comes into effect in Europe. How are insurers faring in their preparations, and do you believe the benefits are significant enough that other countries will follow suit?
Well, most insurers across Europe have made significant progress in their preparation to Solvency II, having started back in 2009 or even before in some cases. However, this does not mean that there is no time pressure nor challenges. Solvency II is probably the most significant change the industry has had to face in a generation, and there are still a number of uncertainties over the final shape of the regulation. For example, we have task forces which are still working on what the cost of property and casualty, health and catastrophic risks should be in the new regime. And likewise, transition measures which are designed to smooth undesirable effects of the shift between Solvency I and Solvency II are still being debated. Solvency II is a very ambitious reform, and it will arguably become the most advanced regulatory framework in the global insurance industry. And this is not lost on a number of countries like Bermuda, South Africa, and many other jurisdictions are moving to adopt equivalent systems.
From your experience, what have emerged as the key implications of the directive on insurers?
Well, Solvency II has three levels of implications. Of course, the first one is to implement Solvency II. For many insurers, this is one of the largest projects they have undertaken. It puts pressure on internal staff, which can only be partly solved by using external resources, because all stakeholders are looking for the same skills at the same time, and also because the need to embed Solvency II into the insurer's staff habits and practices and processes. The second level relates to the organizational and process changes that Solvency II brings. Governance, as well as decision-making processes, must be upgraded to ensure that they are clearly accounted for in the way the business is managed, alongside more traditional dimensions such as growth or profitability. And third, Solvency II introduces new drivers to set capital requirements. This means that the existing balance between capital needs, business mix, product features, and investment strategies will have to change to adjust to the new parameters.
That's quite a heavy burden. Rick, how are insurers acting now to meet compliance requirements?
I think insurers are typically looking at it from two dimensions. Firstly, they're looking at what they actually need to do to comply with the new regime. But secondly, and no less importantly, they're also looking at the business impact and therefore what the strategic opportunities are that Solvency II presents to them. At this point in time, insurers, in terms of their level of sophistication, is very much dependent upon whether they're going for a standard formula or alternatively the internal model. Standard formula firms very much typically focusing upon the calculation of the regulatory requirements under that formula, the own risk and solvency assessment, and also enhancing their systems of governance. Internal model firms, on the other hand, focus not only on the internal model, the governance arrangements around that, and in particular validation, but also the use test and the enabling technology to support Solvency II.
Okay, so what do you see as the key opportunities insurers can derive through compliance with the directive?
I think generally we see four areas that insurers are seeking opportunities. The first one's around improved decision making. So they're looking to leverage new things that are introduced through Solvency II, things like the internal model, things like the own risk and solvency assessment, to actually aid the strategic planning process, reinsurance strategy, asset and liability management and the like. The second area is around product portfolio, where insurers are actually revisiting their portfolios with a particular focus upon those that are capital intensive. So things like life assurance products with embedded guarantees and options, long tail liability insurances, and actually taking a view as to whether they want to reduce the amount of exposure that they write in those areas. Some other insurers are actually looking to write additional product lines to get additional diversification benefit. The third area is actually around capital restructuring and optimisation. So insurers are revisiting their capital, particularly what qualifies as the highest quality of capital, so Tier 1 with the greatest loss absorbency, and also looking at how they deploy the capital across the organisation to optimise the risk-adjusted returns that they generate on that. And fourthly, investment strategy. So insurers are looking at their investment portfolios, particularly those that carry high capital charges such as equities and property, and revisiting as to whether they want to maintain that current balance and portfolio in a Solvency II world.
Francesco, as Deloitte's global IFRS lead partner, can you explain the similarities between the new international financial reporting standards for insurance contracts and Solvency II?
When the EU released the draft framework for Solvency II liability evaluation back in July 2007, they set it in a way that was closest to the IFRS plans for insurance liabilities that the International Accounting Standards Board had published just 3 months earlier. The current exit value, using explicit building blocks, was the valuation that both frameworks required. The 3 building blocks are the mean of a probability-weighted estimate of cash flows under different scenarios, a market-consistent discount rate to reflect time value of money, and a margin for risk and uncertainty. To date, Solvency II has retained the current exit value approach with the all-important day one profit that feeds straight into own funds. IFRS instead has moved away from this approach, driven by more prudent profit recognition considerations. A fourth building block is created, the residual margin liability. This is recognized when the day one profit would have been taken to profit instead. Subsequent release of the IFRS profit follows the fulfillment of the contract. Indeed, the IFRS model is called the current fulfillment value. Ultimately, IFRS is serving the purpose of profit reporting for investors in the insurance sector, whilst Solvency II aims at policyholder protection. And this is bound to create some differences. Even if the Solvency II regulators have the best intentions to stay aligned with IFRS as much as possible, important difference will always remain.
What does all this mean practically? How are insurers meeting the need for change?
Although exit and fulfillment values are different, the building blocks are still there for both models to offer a significant opportunity for implementation synergies. The systems that both regimes would require are immensely complex, and the last thing any insurer wants is to implement an expensive system that needs to be rebuilt when a second set of requirements are overlaid to it. The first building block, the mean estimate of probability-weighted cash flows, is the area where the synergy opportunity is most significant due to the heavy system that needs to be implemented. The other important practical issue is the implementation timeline. The European Commission stated that they are fully committed to the effective date for Solvency II on the 1st of January 2013. Pending an official decision on this, I expect the new IFRS to be mandatory only from the 1st of January 2015.
So although compliance isn't until 2015, there are synergies to exploit in developing processes side by side.
Absolutely. This 2-year gap could be a precious project asset. This time could offer the opportunity to put in sequence the implementation efforts. Insurers could advance significantly with Solvency II before moving to the IFRS implementation. Recycling experienced resources is just one of the main advantages that could be reaped from such a strategy.
Finally, Michel, though it is still many months before Solvency II comes into effect, how are insurers positioned to take advantage of the opportunities you've discussed?
Well, we are already seeing larger groups considering the impact of Solvency II on their strategy and their processes as they move from designing their response to the new requirement to embedding them in their organization. And this is now the time when business benefits of Solvency II will really be locked in. And achieving such lock-in is a matter of careful planning, focused delivery, and a clear understanding of the impact of Solvency II, both on the insurer and also on their competitors, because Solvency II will apply in the same way to all undertakings. Winners will be those who adapt best to the new regime. And after all, as Charles Darwin put it more than a century ago, it is not the strongest of the species that survives, nor the most intelligent. It is the one that is the most adaptable to change.
Rick, Michel, Francesco, thank you.